Gate. No. Gate. Good evening, viewers. Welcome to a live session on futures and options. Today we'll be discussing basics of futures and options. I will just give you a brief that what we'll be talking about in the next 20-25 minutes. We'll be talking about what are popular derivatives where we can trade into. We're talking about key features of futures. We're talking about why FNO, why one should trade in futures and options. We're talking about option types, what are the types of options available, benefits of trading into options, things you can do while trading into options, and the last but not the least, futures versus options. How are options beneficial? How are futures different from options? So let's begin with the first slide, that is what are the various types of derivatives available for us to trade into. The various types of derivatives available to trade into are index, both futures and options. You have stock futures and stock options. You have interest rate derivatives, you have currency derivatives, you have commodity derivatives. Today we'll be mostly talking about stock and index futures and stock and index options. Products which are products where you have participants, and products which are generally widely traded into markets are forwards, which is into currencies. You have futures, you have options, you have warrants, you have swaps, and the participants are basically arbitrageurs, hedgers and traders. So let's understand that what are forwards and swaps, the first and the last. Generally you have forwards and swaps available in currency. Futures, options and warrants is something that is available for stocks. Futures, stock futures is very simple. Generally stock futures tend to trade at a premium of maybe 0.5% to 1% to the price of the particular stock into cash market. For example, if Reliance is trading at 900 rupees, the futures will generally trend anywhere from 905 to 910, depending on the market momentum, depending on various other factors like any corporate action and so on. Options are of two types, call option and put option, about which we will be learning in the next few slides. What are warrants? Warrants are generally not that much traded into Indian equity markets. We have seen that warrants have been issued by companies, which is generally issued to promoters. For general retail participants, warrants have been issued by HDFC Bank way back in 2007-8, and as of now also they have a warrant active, which is traded on the indices. Warrants is nothing but a sort of long dated call option, which you can in a layman language, it's a long dated call option wherein you can buy a warrant. For example, if HDFC at 1800 rupees is offering you a warrant which is available for next couple of years, and it's trading at 300 rupees, you can buy a HDFC warrant in the next 3 years. If HDFC Bank goes to 2500 rupees, the warrant will keep on appreciating along with the stock price of HDFC Bank. Participants, there are three types of participants into futures and options segment. One is arbitrager, someone who is looking to generate 9 to 10% yield on a yearly basis. Arbitrators generally they buy in cash market and they sell in either futures, or they go short on options and they manage it via different type of other instruments. Hedgers, hedgers typically who is looking for 14 to 15% return in a year's time. They have a portfolio and they want to protect their portfolio in case of any adversity that can happen either over a long weekend or overnight on a events case. For example, if there is some geopolitical tension going on, generally people who have large portfolios will like to hedge their portfolio going into the weekend. So they will buy some put option, or they will sell some call options, or they will sell futures to protect themselves in case of there is an adversity. And traders, the last one. Traders are generally we the people who have joined right now, and myself and the entire universe, who is generally looking to generate 40 to 50%, 70% return over a period of time, maybe in a year's time. Generally, trader is someone who is looking to take a trade whenever it is available. For example, I can be a trader who is taking a trade at 3 o'clock for tomorrow. I can be a trader who can take a trade at 10 o'clock in morning and be there in the system for the rest of the day and look for a couple of % of action. So a trader typically will buy maybe at 100 rupees and look for a price of 101, 102, 103 rupees with a definite stop loss. so that in case of trade going wrong, he gets an exit at a minimal damage. Now let's understand some features of futures. The first and the most important thing, you have standardized contracts. So a Reliance Industries has a contract of 500 shares or 1000 shares, and when I say I want to buy one lot of Reliance, it means 1000 shares. You have an underlying asset. Whenever we talk about future prices, let's say Reliance is trading at 905 rupees in futures. So this 905 rupees is derived with relation to some spot price, some cash market price of that particular underlying asset, which is Reliance Industries. So if Reliance is trading at 900 and future is trading at 905, then 5 rupees is the premium you are paying for buying that particular stock into futures market. Now why do people buy into futures market at a premium of 4-5 rupees? Because they have to pay lesser money to buy the same amount of quantity of the shares. Then rollover, another important aspect of trading into futures market is rollover. Now whenever we buy Reliance Industries at, let's say, 905 rupees, and for the rest of the month Reliance moves to maybe 925 rupees, and we have a target of 990 rupees or 1000 rupees on Reliance Industries, then typically what happens is, if you want to carry forward the trade, if you want to encash the trade up to 990 or 1000 rupees, you have to hold on to the same position. Now how does it happen is, you have to square off your positions in the existing month, which means you have to close your open positions for the month of April, and for the month of May again you have to buy next month futures. Okay, now generally stocks tend to trade at 0.5 to 1% premium from the cash market price, and when you roll over from one month to another month, from April to May, you have to pay another 0.5% as cost. So this is something called rollover. Expiry date. The best part about trading into futures and options is expiry date. Generally it happens when we trade into large quantity into cash market. Many a time it happens that if the view goes wrong, we are stuck up with the entire quantity. What happens in futures and options market is, you have to compulsorily take a review of your position at the end of the series when you are approaching expiry. So for example, for the month of April, 26th April is the expiry date. So if I take a position in Reliance Industries today at 930 rupees, if I go wrong, if the stock goes to sub 900 level, I will have to compulsorily take a review of my position on 26th of April. If I don't wish to hold on to the same position for the next month, I choose to square it off. Otherwise, I have to roll on my position, which we discussed on the previous slide, that you sell your current month position and you buy the next month futures for rolling over. Contract cycle, generally you have 3 months contract cycle available in Indian markets. For the month of April, as of now, we have May and June available. So if you don't want to trade into April and you want to hold your position for a longer period of time, maybe for next couple of months till 15th of June, you can directly go and buy June contract, or you can choose to buy a May contract. Now what is important is, for the month of April, the contracts are very liquid. You have a lot of abundant liquidity and you can buy and sell any amount of any number of shares. But when you go to May and June, we don't have huge liquidity available, so you have to be cautious that you don't end up buying at a irrational rate. The other important and the most important factor is margin payment. Now why so much of traction coming to trading into futures and options is, the single most and the influencing factor is margin payment. When we say margin payment, so let's take an example. If I want to buy 1000 shares of Reliance Industries at 900 rupees, I need to pay 9 lakh rupees as margin to the broker, right? So 9 lakh rupees, instead of paying 9 lakh rupees, if I do the same trade into futures market, okay, or into options market, I end up paying far lesser amount than what I'm paying for buying the same stock into cash market in the same quantity. For example, Reliance Industries, I end up paying 9 lakh rupees for buying 1000 shares at 900 rupees per share. If I buy the same stock into futures market, I hardly have to pay around 1.1 lakh rupee for the same quantity. Because it is into futures, I just need to pay 12 to 15% of margin. Now this 12 to 15% of margin vary for different stocks. For indices futures, you generally have a margin of 8%. For stock futures, you have a margin anywhere ranging from 11 to 40%, depending on the nature of the stock. Margin very often is derived by a formula which is influenced by the volatility of the stock. If you are trading into very volatile stock, the margins will be higher. If you are trading into lesser volatile stock, the margins will be on the lower side, anywhere around 11 to 15%. If you are trading into indices, which is even less volatile, then the margin drops down to 5 to 8%. Mark to margin. For 1,000 shares, you have already paid a margin of maybe 1 lakh rupee. Because the stock has corrected by 25 rupees, you have to pay 25 rupees into 1,000 shares, that is 25,000 rupees as margin payment, mark to market payments, right? What we suggest is, whenever you are taking a trade into futures and options segment, always provide for mark to market, because in case of an event, market correcting and the stock still being strong, but stock will definitely correct with the market, you should have sufficient M2M provisions done, so that if there is some sort of volatility, you can withstand that and hold on to your trade till market settles down. Short position is possible because of futures and options available. Imagine if you don't have futures and options available, if you want to go short on Nifty because of some geopolitical tension, or some political turmoil going on globally, or some any other bank meets or something, there is no choice available. But because there is futures available, there is options available, you can always go and hedge your portfolio by creating short positions. For example, if you have a 1 crore rupee portfolio, just go and sell equivalent amount of Nifty. So 1 crore rupee portfolio will attract selling Nifty of 1 crore rupees, which is around 1050 shares. Go and sell 1050 shares of Nifty against your portfolio. If market corrects, portfolio will take a beating of maybe 7-8% if market corrects by 5%, but at least those 4-5% of market fall can be captured by going short on indices future or buying a put option. There is no circuit limit. In case of an event where the stock is just hitting a lower levels of 15%, 20%, 25%, there is no circuit limit. In case of stock opening up by 10-15%, there is no circuit limit when it comes to futures and option stocks. For example, on the event of bank recaps happening somewhere in the month of October, we saw many of the banks opening up by 8-10%, and then from there on they kept on going up by around 20, 25, 30% during the day's time. So if the stock is into, if not in FNO, you will have a circuit limit of 5, 10 or 15, 20, 5, 10 or 20%. But when the stock is in futures and options, you don't have circuit limit. You can just keep on participating along with the stock during the day by 20, 25% and 30% also. Index trading is possible because of futures and options. If I want to trade into Nifty, I can trade into Nifty. I can buy 1 crore worth of Nifty by paying just 7 to 8 lakh rupees upfront as margin payment. So this is something which is very attractive, and whenever market corrects big time, we have people who trade into indices. They just buy at, let's say 10,000, 10,100 level, and whenever there is a pop, it's very easy to sell. You don't need to wait for delivery, and you don't need to take a big picture view on fundamentals of the stock or something. You just take a view on the indices based on technicals and derivatives. Take a trade. There is no delivery shortage on anything sort of when you trade into futures. And an example how you end up paying far lesser money than what you have to pay when you buy into cash market. Reliance Industries, if you're buying into cash market segment, 1,000 shares at 900 rupees per share, you end up paying 9 lakh rupees, which needs to be paid within T+2 on a T+2 basis. Investment involved is close to 9 lakh, like 12,500 needs to be given at the beginning. After this, if stock goes down, you need to furnish fresh M2M provisions, mark to market provisions. If the stock goes up, even that needs to be, that don't attract any M2M provisions. Now coming to options, there has been a lot of traction into options in last couple of years time, particularly 2016, 17 and 17, 18, we saw a lot of volume happening into options. Of late, after the introduction of Bank Nifty options, we have seen that in last 18 to 20 months, a lot of volume has started happening into Bank Nifty options. So it is very important to participate in a segment which is attracting volumes, and if you are not present over there, probably you are losing the opportunity to make money. In perspective of how volumes have shifted from futures to options, if you can look at 2007-8 data, the blue line indicate futures. Futures are almost at the same level till the last year, when in terms of volumes. But if you look at the green bar, which signifies, which is representing options, there's a huge growth which has taken place into options volume. So if you are not present into somewhere where there is huge volume happening, probably we are missing an opportunity to make money. Now there are two types of options. One is call option and the other is put option. Call option, generally when we say that we are trading into call option, and if you are buying a call option, we are bullish on market. If you are selling a call option, we are bearish on market. If you are buying a put option, you are bearish on market. If you are selling a put option, you are bullish on market. Now this also, the being bullish and being bearish also changes sometimes. For example, if I'm at 10,400 Nifty and if I go and sell 11,000 call option for 10 rupees, probably I'm not very bearish on market, but I'm actually expecting market to go up to 10,700 or 11,000 level. That's why I'm selling 11,000 call option, which means that although it's a bearish sign, but I'm expecting market to go up, and in case market goes up, I don't want to attract any losses or any M2M provisions unless and until it breaches 11,000 level. When I say I'm buying a call option, I'm bullish on market, and in that case, I just need to pay the premium amount. For example, if I'm buying a Nifty 10,500 call option when I'm right now trading at 10,400, I just need to pay 50-60 rupees for buying that particular call option. If I pay 50 rupees for buying a call option, 50 rupees into number of shares, let's say I buy 1000 shares, I need to pay 50,000 rupees upfront to buy that position, and 1000 shares actually gives me an exposure of 1000 to 10,000 level of Nifty, which is close to 1 crore rupees. So I can take a 1 crore rupee exposure by just buying 50,000 rupees call options. Similar goes for put. If I'm buying a put option of 10,000 shares at 30 rupees, I need to pay 30,000 rupees as premium amount, but that is giving me exposure of 1 crore worth of Nifty on the lower side. If market corrects from current levels of 10,300, 400, and if it goes to 9,500, my 10,000 put option will keep on giving me money till I don't square it off, I don't hedge it against any other instrument. Example, a very simple example which we have been dealing with, or many people have dealt with in the past. First is, if you want to buy a house 25 lakh rupees, many a times it happens that we need to arrange for cash, we need to arrange for bank loan or something. So we end up paying a token amount of maybe 50,000 rupees, which is valid for 2 months or 50,000 rupees, which is valid for 2 months or 3 months period of time. After 1 month, if you get an offer of 28 lakh rupees, you can simply sell that house for 28 lakh rupees by buying it from the existing buyer, because you have a right to buy it from the existing buyer as you have paid a token of 50,000 rupees to him. There is a total profit of 2.5 lakh rupees, 25 lakh rupees the cost of the house. You have a premium of 50,000 rupees, that is token amount for buying that house. So your net cost is 25.5 lakh rupees, and if you sell it at 28 lakh rupees, you have a benefit of 2.5 lakh rupees in a very short period of time. Now this is exactly what happens in a call option, or this is exactly what happens in a put options. If you are buying a Nifty 10,500 call option at let's say 100 rupees, your cost of holding Nifty goes to 10,600, that is 10,500 strike plus 100 rupees, 10,600. If market keeps on going up to 11,000 level, the same option will start trading at 500 rupees, which is 11,000 rupee level of cash market price of indices minus the strike price you have bought, that is 10,500. So you have 500 rupees advantage. Now out of this 500 rupees, 100 rupees what you have spent upfront for buying that particular call option, so you remove 100 rupees from it and you are left with 400 rupees of profit. Example of a call option. If you buy one lot of Nifty 11,000 call option at 60 rupees, and if Nifty closes anywhere below 11,000 level, let's say 10,700, 800, 900, even 11,000, then the entire 60 rupees of premium paid will go off. It will become zero by the end of the month, and that will be a net maximum loss that you will take if you are buying a call option. But if market starts moving up, if market starts going to 11,100, 200, 300, 400 level, then this call option will keep on going up, and as you can see it on the screen, if market expires at Nifty expires at 11,100 on the day of expiry, the same 60 rupees call option will give you a profit of 40 rupees. How? 11,100 is the expiry level and 11,000 is the strike which you have bought. So 11,100 minus 11,000, you are left with 100 rupees, and out of that 100 rupees profit, you have already paid 60 rupees as cost at the beginning of the trade. So your net profit in that case will be 40 rupees. If Nifty expires at 11,400, it's 11,400 minus, so 400 is your net profit minus 60 rupees of cost. You are left with 340 rupees of profit at the end of the month. Let's take an example of put option. So buying a put is like buying an insurance policy. Let's suppose you buy an insurance policy for your car. You have to pay a premium amount of, let's say, 5 to 7,000 rupees for a car of value of 5 lakh rupees. Okay, now those 7,000 rupees will that 7,000 rupees is the cost of buying an insurance policy for your car, which will protect you from any sort of theft or any damage that can happen to your car in the agreed upon time frame. So if you are taking an insurance premium of 1 year, if something goes wrong to your car in that 1 year, some theft happening or anything else, then the insurance company is liable to pay you for the amount of the car value, which is agreed upon at the time of taking the policy in the policy itself. So this is exactly how a put option performs. If you are buying a Nifty 10,300 put option when Nifty is trading at 10,500, and if Nifty goes to and you pay a premium of 50 rupees, if nothing happens, that 50 rupees goes away. That's the cost of buying a protection for your portfolio. If something goes wrong, Nifty goes to 10,000 level, then you get 10,300 minus 10,300 rupees. If you have bought 1,000 shares, you will get 30,000 rupees of payout at the end of the series. And for buying this 10,000 rupees of for buying this protection up to 10,000 level, and for looking at a potential profit of 30,000 rupees at the initial, you have spent let's say 50 rupees into 1,000 shares, 50,000 rupees. So 50,000 rupees what you have spent, and sorry, I beg your pardon, the profit will be 3 lakh rupees. From 10,300 to 10,300 rupees into 1,000 shares, it's 3 lakh rupees. So 50,000 is the cost of protecting your portfolio. If something goes wrong, there is some event happening globally or domestically, and Nifty corrects to 10,000 level, you get a outflow of 3 lakh rupees, which is 3 lakh minus 50,000 rupees, 2.5 lakh rupees of profit. Example of put option. If you buy one lot of Nifty 10,000 put option at 50 rupees, and Nifty is trading at let's say 10,000 level, if Nifty keeps on trading above 10,000 level till the expiry, this 50 rupees of premium which you have paid at the beginning will become zero by the end of the month. But if Nifty corrects and Nifty corrects to 9,600 level, the same 50 rupees option will become 400 rupees, and it will give you a profit of 350 rupees. Some benefits of trading into options. In equities, if volatility is high, there is a probability of you hitting a stop loss which is very higher, and this can happen on account of global news or domestic news. Generally, we have seen that in equities or in futures market or in cash market, trading is difficult and exit is even more difficult. There is a high probability of getting stopped out, and many times it happens that even if the stop loss gets triggered, we keep on holding to the same stock because of indiscipline. For investors, there is a massive erosion in portfolio value. When it comes to options, volatility actually helps the option trader to take advantage of it. We can have option strategy for any view, bullish, bearish, or range bound. Predefined stop loss with time frame is always there when it comes to options, because you have the maximum loss you can bear, you can face is the premium amount that you have paid, and the time frame is always there, because beyond the expiry you cannot hold on to the same instrument. You can have portfolio protection strategies as well as income generation strategies also when it comes to options. When it comes to equity, you just need to hold on and sit on it. When it comes to options, you can protect the same portfolio and you can generate some income also out of it. That's what we discussed in the previous slide. Options for traders, you have bullish view, bearish view, and range bound view. So trader can take a trade on bullish, bearish, or range bound market. investor can protect his portfolio or can generate some income out of options. In small example, how options are beneficial, more beneficial about futures is, if Reliance is trading at 950 rupees and you take a trade with a stop loss at 935 for a target of 975. When you trade into futures, you have to pay a margin of 1,12,500 rupees and you have to put in another 25,000 rupees as M2M provisions. So you need close to 1.5 lakh rupees. Stop loss is close to 15,000 rupees and profit is around 25,000 rupees because 1,000 shares into 25 rupees of upside from 950 to 975. Rate of return on investment is close to 20-25%. Now when you take the same trade into options, firstly, you don't have to deal with indefinite losses, because when you're trading into futures, if Reliance opens at 800 rupees for some reason, you face a loss of 150 rupees per share. But when you're trading into Reliance Industries option, you buy an option for 1250 rupees for 950 strike, so your net outflow is 12,500 rupees. If the trade goes right, you end up making a profit of around 12,500 rupees. If your trade goes wrong, you end up making a loss of around 7,500 rupees. So if you make a 12,500 rupees profit, it's around 100% of profit on 12,500 rupees invested. That's all from our side. If you have any queries, we can take some questions, and I'll be happy to answer them. That's it from our side. If you have any questions, you can always get in touch with the contact centers at Sharekhan, and we'll be happy to help you. Thank you.